Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Portfolio here.
Welcome. Today, it's after Labor Day, and we're looking at what's in store for all of the markets, but particularly AI today. I'm Steve Davenport, and I'm here with Clem Miller, and today we're going to talk about AI, delivering or disappointing. So when I think about the momentum that we've seen in the big names and the momentum particularly in Nvidia and other semis around AI, Clem, I get a little bit reminiscent of the 2000 technology bubble and what happened there. And I see a lot of prognosticators talking about how we've gotten away from what we would call reasonable prices for a lot of the names in the market that are related to technology, particularly AI. And I start to think back to the 2000 and what it felt like, and how every day you went into the office and you said, "Oh, I wish I bought this," and the next day it was up. My favorite story from 2000 was I had an old portfolio manager, and I don't mean old in a derogatory manner, but an experienced person who heard about Cisco. And he decided to go buy some, even though he didn't understand what it did. And he ended up buying the food supplier for companies and colleges, Cisco SYSCO instead of CISCO.
Right.
And I think that a similar thing might be going on today with some of these AI names. There seems to be just a flurry of activity. And some people don't want to buy the leaders because they feel like they've already seen all the price appreciation, and they're looking for secondary and tertiary names in this space. And my question is, are all of them going to survive? Are all of them going to make money? Are all of them going to turn from this is a great idea to this is a great service or product, and this is something that we can do at a reasonable price for future growth? It feels to me like this area, I believe it has potential and I believe it will succeed, but I just don't know if it will succeed for all of these names and all of these multiples that are currently out there for some of the Nvidia and others. And I think that we have to look at this as Nvidia and others, because Nvidia really seems to control so much of the market, as we talked about earlier. Their software for designing chips and also their chips themselves. So, Clem, is AI going to be disappointing, or is it going to be delivering for us in the next 6 to 12 months?
So, Steve, thank you. I am growing increasingly concerned about AI, the future of AI, and whether markets have really gotten ahead of the reality. Now, AI is a real technology. So I don't want anybody to think that it's like crypto, for example. It's a real technology. It has a lot of applications. It's got a multi-year long or multi-decade long future ahead of it. But I think valuations have gotten ahead of AI, especially compared to other stocks, other opportunities that are out there that one can buy. And so in my own portfolio, I have pulled back a little bit from AI, from the large tech stocks and the semiconductor stocks, and have moved more into defensive areas, which we can talk about.
Is that
But
because of a recession, or is that because one has just become out of the pricing has become bad for, yeah.
well, some of my defensive names are also somewhat expensive. So it's not entirely because of valuation. It's because they're defensive. So let me just remind everybody what at least what I mean by defensive. Defensive doesn't necessarily mean, in fact, it doesn't mean the same thing as high valuation versus low valuation. What defensive means is basically high beta versus low beta. Beta being the sensitivity to the market. So the things that have a high beta are some of the technology stocks, not all of them, some of them, and things like banks and materials companies and some consumer discretionary companies, some industrials. Then you're talking about lower beta stocks. Lower beta stocks, those that are more defensive, would include healthcare and consumer staples and consumer staples, healthcare, utilities. I tend to stay away from utilities. So in terms of both the more sensitive and the less sensitive to market movements, stay away from utilities, and I kind of stay away from banks in terms of the more sensitive. But
Does some of the fervor around these healthcare companies like Lilly and Novo around the diet, or I
yeah,
guess we call them obesity
right.
drugs? I mean, it feels to me like it's a secondary bubble. Do you agree, or do you think that, when people got tired of buying AI technology, they started thinking about obesity, and it feels like it became a secondary. Do you look at that way, or are you interested in those names?
Well, I think that okay, so I hold both Lilly and Novartis, as well as a number of other pharmaceutical and healthcare companies. And I
Did you
think
hold them before there was this, or did you hold them? Are you holding them because of this
because
obesity?
of no, I think I'm focused a lot on some of the numbers, right? So I spend a lot of time thinking about numbers and not necessarily about themes, although themes add into it. So I'm not buying Novartis and Lilly because of the obesity drugs. It's not a because of. I'm holding them because of other factors. So, I've mentioned before about trying to focus on lower short interest ratios. Well, I am looking at that. And in terms of being a little bit more fearful about a market downturn, I've sort of dialed down to a lower beta for the overall portfolio. So that's why I've got, more defensive, a higher weight of defensive stocks in my portfolio. And to some degree, I'm looking at PEG ratio too. I know you look at PEG ratio. And, one of the issues with PEG ratio is that, it all depends on your expectations, or market expectations, I should say, of earnings growth in the future. And,
Right. I think the
and
hardest thing is that peg ratios absolutely kind of lose their value as you go out in terms of a growth rate for
right,
2 years, 3 years, 4 years, 5 years.
right.
I
And
think you can make a 1 year peg
yeah.
ratio, but if you're not looking to hold stocks for a year, but looking to hold them for 3, 4, or 5, then
So on a long-term PEG ratio, Nvidia looks pretty cheap, but that all depends on, whether the market, or analysts, I should say, are accurate in their prognostications.
right.
And I'm not 100% convinced about that. Now, I still, I do hold Nvidia, but am I betting the farm on Nvidia? No, absolutely not. I don't think anybody really should bet the. It's all up to you. I'm not making an investment recommendation, but let me just say about myself that I'm not betting the farm on Nvidia.
Well, don't you think that it will eventually be the winner here? I mean, it's going to grow into, I mean, it's already grown into being up 100% in revenue and earning, it's already
Well,
growing into its number. So,
well, when you're talking about share price growth that is so high, the thing you have to worry about is not, or the thing you have to expect is not that it will continue, but that you're going to see some pullback on that 100%. It's actually better, in my mind, to sell some of that Nvidia and reap the gains than to sort of let that rip. So, from a practical standpoint, what that means is that as the weight of Nvidia in my portfolio has grown, I have trimmed it to reap some of those gains and reinvest them elsewhere. But
yeah,
I'll tell you, I am not so much concerned about Nvidia as I am about some of the Mag 7 stocks. I'm not in Tesla at all. I have concerns about Microsoft. I have concerns about Amazon. I have concerns about Google. These stocks have not performed well recently, and they're not inexpensive. Their peg ratios obviously depend on future growth as well. Their short interest ratios are pretty good, but you know, you just haven't seen the performance there. So you really have to make an educated guess about when they'll turn around. And I just don't have a feel for when those will turn around. Now, that's not to say I don't hold them. I do hold them, but I wouldn't be putting new money in there as the market pulls back a little bit.
can I just clarify something?
Yeah.
I have most of my assets in an IRA. And
Yeah.
when you
Me
talk
too.
about selling, are you selling in a taxable or a non-taxable? And can you just talk about what, prevents you? Because I agree with trimming. I agree with doing these
No,
things. But I
mine are
also
in
have to be sensitive to the
the
people out
vast
there who might be
the,
owning
lar-
these
the
things in taxable
yeah
accounts
the,
where
la-
selling and trimming is, can be a little painful.
right, the large majority are in an IRA, so I have no issues with with selling and buying. um they So I don't have to track that, although I'll tell you, it is useful to look at the I find it useful to look at the unrealized gains and losses numbers to give me a sense of when I might trim. So I think it's a useful indicator, and if I have a lot of unrealized gains, that just tells me, even though it doesn't mean anything to me on taxes, it tells me that maybe it's a good time to sell a little bit, you know, rather than let these things run. Now I know I'm sort of contradicting myself a little bit uh, from some prior podcast episodes some time ago, where I would say, I have a tendency to let things rip for a while. I think I'm a little more sensitive in this market to not letting things rip. Um, or let me put it another way. When I look at my portfolio and its performance and what the market's doing, I would rather stay invested in the market than pull back and have a lot of cash. I'd rather stay in the market, but I want to change and shift around what I invest in, which is why I go to I'm shifting subtly towards the lower beta.
I think that makes sense. I think it's the right idea. I'm just trying to, sometimes I get into the, what are we going to have in the future? And what are we going to have in 25 and 26 in terms of cap gains rates? And in some ways, I think now could be a good time to sell, because I think that, after I was a little bit overwhelmed after that last discussion with Steve Gattuso and the debt. It's a very discouraging topic in terms of what are we going to do, and it feels like increasing taxes is the natural decision, but natural decisions don't necessarily come when you have other people with other agendas, right? And I just think has to be some reckoning, and some people who pay taxes at a lower rate are going to be a natural place for politicians to look when it comes to how do we find more money. So I'm trying to help everybody be efficient, but the uncertainty about tax rates is a variable that we have to kind of put into the blender as we mix them all up and come up with a smoothie for the future of our portfolios. So I like the idea of doing a little bit now where you know what your rate is versus pushing it off into the future where you don't know. So when we look at AI, Clem, I don't think we have to have the answer, but I want to try to at least give people a sense of when things get out of whack, or we feel that they're above multiples that we think they can maintain. What is the point or the dividing line between something that looks just a little expensive and something that looks like we need to act and do something? I mean, do you have a peg ratio or a number that says, hey, when I'm paying 3 or 4 times the growth rate, it's just too much? And is there a number in your mind that you use to try to make those decisions?
So I would say there are 3 numbers. And in a way, you can kind of think about it as, multiplying the 3 numbers in a sense, so that all 3 of them are kind of levers, right?
Yep.
So I get a little concerned. Let's start with short interest ratio, which is the ratio of short interest divided by free float shares outstanding. I would, I get a little I get nervous when short ratios are above 2%. So that's one indicator. Preferably lower, right? I don't think that when you get below 1%, there's any great improvement that you get moving from 1% to 0.7, 0.5. Most things, I'm very comfortable with a 1% to 1.5%. When I get above 2%, that becomes a concern. So there's that. On beta, I mentioned that I want to keep beta relatively low in my portfolio. And so in order to do so, I have to be concerned about stocks that have higher betas. Nvidia being one of those, by the way. And I would say that, definitely 2 is too high. I feel much more comfortable with under, say, 1.4 or 1.5 beta on an individual stock. Of course, that's something where you can do a weighted average in your portfolio, right? If you have a bunch that are like 0.5, like the defensive ones I was talking about, healthcare and so on, that offsets it. And then I've got peg ratio, and I get concerned about peg ratios really that are above 2. I've got only a few. I got only a few of those in my portfolio that are above 2. I think if you had to weight average the peg ratios in my portfolio, I'd say they're like 1.6, 1.7, something like that. I have a few that are really high, and I get really nervous about those because I know that a really high one means a lot of difference, right? And the one that we've talked about, one that is of obviously great concern in a prior podcast, one that keeps doing well despite a high peg ratio, that's Costco. So I always keep my eyes open on Costco. I still hold it, but it's high. So I think one way to look at this issue, like I was saying, is to maybe look at the multiplicative product of the three indicators I just mentioned: short interest ratio, PEG, and beta.
Okay, it's a good idea.
Yeah.
Well, I feel that the AI story has become Nvidia plus others. And I'm trying to figure out, looking at the secondary names, do you feel that there's some obvious answers in terms of the people who are going to succeed are close? When I look at the AMD and I think about other chip makers, it's going to be very hard for them to supplant Nvidia. But I look at server farms and some of the storage and some of the other needs, and I feel like there's where a pretty big opportunity is going to exist. Do you look past the Nvidia story and say the secondary beneficiary is going to be company X? Where do you see the secondary opportunities around Nvidia and AI?
So I do not own AMD. I think that they're they don't fit the numbers that I was just talking about. So they're going to play second fiddle, a way back second fiddle, much smaller proportion of the AI related semiconductor market than Nvidia is. So I'm not terribly optimistic about AMD. I like even though it's not even though it's not an AI focused semiconductor company, I like Broadcom. That's AVGO.
Yep.
So I like Broadcom. Um, so that is in my portfolio. I have when I look at I do have ASML, which is the monopoly or near monopoly producer of semiconductor manufacturing equipment. I think they're going to do well no matter what. I do not own Taiwan Semiconductor, which I think is for obvious reasons surrounding geopolitics. Although honestly, if you have a problem with Taiwan, it's going to affect the entire sector. So I think those are those. I mean, at Broadcom and Nvidia. Let me just look quickly through my portfolio here to see if there are any others I'm forgetting about. Um,
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
Well, there's one other article I read this week that I'm not sure.
no, I
What?
don't. I don't have. I don't have any. I've got other tech companies, but I'm really down to those two in terms of semiconductors. I have things around. I have things around like switching equipment for networks, like Arista Networks is one of my favorite companies.
Yep.
So,
And CrowdStrike, right?
nope, I don't have
Um,
CrowdStrike.
One thing I read this week was about the culture of Nvidia, that they've now created so many millionaires, and that the people are all driving cars in Nvidia color, and it's got a very tough environment. That the engineers there are expected 7 days a week, 12 hours a day, and it's a very, very difficult to get people to talk about but the culture is very different, it's tough on those employees, and you don't get those type of bonuses and stock options without delivering on a regular basis in a very competitive space. And I know you look at some of the things on employee satisfaction and some employees. I think that the culture and whether the culture can be maintained should be as much a thought as to whether the growth rate can be maintained, because they're one and the same, right? If you don't have the employees who are willing to keep making every quarter super important and making sure they hit every goal, and I think that my desire for Nvidia is to improve their culture so that they can maintain their strengths going forward. Because I don't think that the culture the way it is today is really possible to maintain.
I 100% agree with you. I would also point out, SpaceX and Twitter and Tesla, the Elon Musk companies. He's got a culture which is essentially a negative culture as well for his companies.
Right. I understand where you get wrapped up in a concept and an idea and you move it to a point where it gets recognized. But I also understand that, they're not machines. They need to be able to rest in order to be able to think clearly and add value. So I'm a little bit surprised that the culture clash of employees being expected to do more.
Yeah.
And that when we took away people's privacy by saying, hey, you're on the phone 24/7. If I have a question on Sunday afternoon, I don't just wait until, 9:00 Monday. We talk about it and we interrupt your football time and your family time. So in my mind, those are still legitimate concerns. And I
agree. And one of the things we may have talked about this before.
Talk about it much, do you, Clem?
Yeah, what?
You don't hear people talk about it much.
Yeah. In fact, you got all this emphasis on ESG, and employee satisfaction should really be high up on the S and the G part of ESG. But they don't look. These indicators and these ESG indexes and indicators, they don't look at employee satisfaction. They look at other things like injuries on the job and so on, which are not reflective of employee satisfaction. And I really think those indexes should. So I do look at Glassdoor ratings for employee satisfaction. I like to see Glassdoor ratings that are above 4, but I'll go lower on some of them. And in certain cases, I'll give the benefit of the doubt and go lower. So, for example, I hold RSG, Republic Services Group, great company, but it's a garbage company, right? And so how high is the employee satisfaction?
You don't say it like that, Clem. You just say it's a waste removal company.
Waste removal company. But how high can its employee satisfaction rating be? Really? So I discount that indicator for that company.
All right. Well, I think we wanted to touch base, and I think we have touched a lot of points about AI. If we were to wrap up, my comments would be, it's always good to look at your portfolio and make sure you understand how much risk you're taking and how much you've made. And I think we've covered that pretty well. I believe that there are other things secondarily, like employee satisfaction and how you're treating employees and whether that growth rate can continue based on that employees. I know they could hire new employees, but there's obviously been a very competitive culture and it's produced great results, but I don't believe you can continue in that vein just using the same resources, because I think there's, people burn out. So my concern for AI isn't just on the chip usage, it's in the employee usage. So do you have any more points to make, Clem, for as we close this out on AI and developing or disappointing? I'd say we're somewhere in between, right?
Yeah, I would just say that this is a struggle between valuation and growth. And I don't think I think right now AI is a little bit growthy or a little bit pricey in terms of valuation. I think that the growth story will continue. I think it's a great theme going forward, but it's not something where it would be crazy to buy an AI thematic ETF, which doesn't distinguish among companies of different valuations and different qualities. That would be a mistake. You need to look at individual companies and make decisions, as I have done in my portfolio in terms of not holding a lot of different semiconductor stocks, but kind of focusing it.
Yeah, I mean, I would add to that I'm not sure if you haven't been participating with any of these names that now is the time to start. I believe that this theme and some of these names you could have been participating in without knowing really, by holding a general semiconductor ETF or holding some other exposures here. But I believe that we're seeing more clouds on the horizon that are going to make it more likely that these prices could become more reasonable. And I would say patience is the thing to do here. So that's how I look at it, is let's throw a little patience at it, and some of these names may come back and be at more reasonable prices where you could expect better long-term returns. So thanks everybody for listening, and please share and talk to your friends and let them know that you've enjoyed Skeptics. Thanks.
Thank you, Steve.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.